Hello traders, welcome back to Nova channel and let's continue a very important topic today. There is a secret force that controls the gold market and it's not what you might think, it's the US dollar. While many scalpers only focus on the gold USD chart, professional traders only glance at another chart to seek information. Today, we will explore the inverse correlation between gold and the USD, understand why it exists, and most importantly, how we can use this relationship to enter gold trades with higher confidence. And first, let's talk about this fundamental truth. Gold and the US dollar typically move in opposite directions. When the value of the USD increases, the price of gold tends to fall, and vice versa. This can be observed by comparing gold charts with the US dollar index, known as DXY. So, why does this opposition exist? Imagine it simply. Gold is priced in US dollars. When the US dollar gets stronger, it holds for more value relative to other currencies. This means that you buy an ounce of gold, you need fewer dollars, which make gold more expensive for buyers in other countries. The reduced demand will push the price down of gold. Conversely, when the USD weakens, gold becomes more attractive and its price tends to rise. And now let's explore why this correlation exists. This correlation is not random. It stems from macroeconomic factors. Understanding these factors will give you a deeper insight. First, we were talking about interest rates. When the US Federal Reserve, the Fed, raises interest rates, the US dollar becomes more attractive to investors because they can earn higher returns from holding it. In contrast, gold is an unyielding asset, so demand for holding gold decreases. And the next factor is inflation. Gold is often considered a hedge against inflation. When inflation rises, the value of the US erodes, causing investors to seek refuge in gold, and its price tends to increase. And lastly, safe haven psychology. In times of global geopolitical or economic instability, both gold and USD can be considered safe haven assets. However, in most cases, the inverse relationship still prevails. And now let's move to the most important part of today's lesson, how scalpers use this correlation. This is the most important part. How do we apply this knowledge to our actual trading? Consider the DXY as a powerful confirmation tool for your gold trading signals. Now, let's start with step 1. Find a high probability setup on the gold USD chart. Looking for a clear signal on your gold chart, for example, a bearish reversal candlestick patterns like a shooting star or bearish engulfing at a significant resistance zone. This is your primary setup. And next, step 2. Check the DXY for confirmation. After you have a setup on a gold chart, quickly switch to the DXY chart, or you can follow this instruction. If gold is showing a sell signal, which means going down, let's check if the DXY at a strong support level and showing signs of moving up, like a hammer or bullish engulfing candle. And the second scenario is if gold is showing a buy signal, is moving up. Let's check if the DXY at a strong resistance level and showing signs of moving down, like a shooting star or a bearish engulfing candle. If both charts are telling the same story, like gold down, DXY up, or vice versa, then it's an extremely strong confirmation signal. The confidence of your trade will increase significantly. In conclusion, the correlation between gold and USD is not absolute rule, but it's a powerful tool that helps you to see a bigger picture of the market. Use the DXY as a final filter before entering a trade to increase your probability of success. My final advice is to practice. Open both gold and DXY charts and go back in time to find examples of this correlation. Finding and observing them yourself will help you remember apply this knowledge much more effectively. I wish you success on your trading journey. See you in the next video.